Today, we are looking at the Bitcoin weekly chart through a strictly institutional lens. We've shifted to a logarithmic scale to better visualize the long-term growth curve, and we've stripped away the noise to focus on the three moving averages that define institutional behavior: the 50, the 100, and the 200-week SMA. As of late December 2025, Bitcoin is sitting at a critical crossroads. The easy money phase of the rally has concluded, and we are now entering a phase of high timeframe structural testing. Let's break down the technicals. Look at the alignment of our SMAs. This is a classic bullish stack, but the price action is starting to challenge the upper tiers. First, notice the 50-week SMA, currently near $101,600. This was the primary support throughout the late 2024 surge. Losing this level was the first definitive sign that the immediate parabolic trend had broken. When price trades below the 50-day simple moving average, the market moves from a momentum phase into a value phase. Currently, we are resting on the 100-week simple moving average near $86,000. Historically, the 100-week is the pivot of truth. In a healthy bull cycle, this is where deep-pocketed buyers step in to defend the macro trend. If this level holds, we consolidate. If it fails, we look toward the iron floor, the 200 simple moving average you see in blue, which is currently around $57,000. Now let's look at the geometry. On the logarithmic scale, the rounding bottom of 2022 and 2023 stands out as a massive period of institutional reaccumulation. That was the foundation. But now look at the structure at the recent all-time highs. The character of the market has changed from accumulation to distribution. We have printed a clear high time frame double top, an M pattern at the highs. We saw two distinct peaks where buying pressure exhausted itself against heavy supply. This pattern suggests the blow-off top phase is finished, and smart money, most notably OG whales, have been distributing positions while retail and institutional buyers, via ETFs for example, have been buying, but not in an overly aggressive way. We saw two distinct failed attempts to sustain prices above the $120,000 range. The breakdown from the second peak was sharp, slicing right through the 50-week SMA. The current neckline of this pattern sits right here at our $86,000 mark. This is why the 100-week simple moving average is the most important line on your chart right now. It is the final barrier preventing a full technical confirmation of a macro reversal. But now look at the structure at the recent all-time highs. The character of the market has changed from accumulation to distribution. While the price has made a much higher low compared to 2024, the RSI has actually printed a lower low. This suggests that while the price looks weak, the selling energy is becoming exhausted. We are seeing similar exhaustion signals on the MACD. To wrap up, the macro trend is still bullish, but the intermediate momentum is broken. Keep in mind the bear case. A weekly close below the 100-week simple moving average at $86,000 opens the door for a much deeper correction toward the 200-week simple moving average at $57,000, and there is the bull case. Reclaiming the 50-week simple moving average, $101,600 is mandatory to invalidate the double top and restart the trek toward new highs. At this stage of the cycle, patience is your greatest edge. One approach traders might use is to not front-run the bounce, but wait for the weekly candle to confirm that the 100-week SMA is holding. Whatever you do, do your own analysis, manage your risk, and keep your position sizes reasonable. That's all for now. We hope you found our analysis useful. If you did, please give the video a like. And don't forget to subscribe to our channel to receive notifications when we post future videos. We plan to be posting more often as we get into January. There are interesting days ahead.